the first week I started testing, I could have the best month ever in my life.
I started seeing the data from prop firms. Something like over 70% of the people who are withdrawing on a consistent basis, let's say longer than 1 year, over 70% of them are more higher time frame traders.
Like on Friday, I had the 7 setups coming up because I had trade actually multiple currencies, and I trade the best setup I would see that is coming up. So we have 7 setups. It's not like I'm going to trade 7 trades at the same time, because then your floating risk might be a lot. So
There were two main catalysts. The primary one was I started teaching more, and I found that when it came to actually communicating my thought process behind my trading, so much of it was just derived from my experience. It wasn't as mechanical, let's say. It wasn't like I was doing the same thing day in, day out. So in the last year, I've had one losing month in the last 12 months, and it was when I was just doing lower time frame. So it's much more volatile, more room for win, but also more room for loss.
okay, guys, welcome to another session with me and Luke, my dear friend Luke from Chile, and me currently residing in Serbia. So today we're going to discuss different trading strategies, because recently we developed some trading models that we would like to discuss together. We might speak about psychology as well. Actually, last time we spoke a lot about psychology. This time we might touch certain topics, but today mostly we're going to talk about how to develop a trading model, what are foundations, what it entails, and then of course, if you guys, because this is going to be shared on different YouTube channels, if you guys have any questions, please let us know. Would you like anything else to add, Luke?
Yeah, I think a full circle coverage of what it takes to first initially have the inception, the idea of the trading model, and then bringing that into reality. The whole process behind, yeah, the thought generation and then actually execution, testing, etc. I think it's pretty cool because we both just developed a new model now. And what comes with the new model is always that shaky period, that getting used to oiling it up, let's say, before it's fully functional. So we're probably both in a similar stage of the model. How long have you been developing the swing strategy that you're using now?
Well, I've been using it for a while, because I've been using it on other asset class stocks, but it was mostly spot trading. But now I decided to actually get to forex, to the forex world. The first week I started testing, I could have the best month ever in my life, almost, if I've done some things properly. But then 2 weeks after, 3 weeks after, I had a bad week. What maybe reanalyze certain steps. What should I do? What should I follow? What should I look for? But yeah, uh, that has been in building some time, from different asset class. I wanted to see how it's behaving on different asset class like forex. It gave me some really good results. I had profit factor of 5.4, I think. For people that are trading, one is break even, and that was a really good profit factor just after a few weeks of testing. And now, actually, I'm going to have some questions. You might be able to help me out. Uh, um I'm trying to sharpen a little bit edge when it comes to risk management and break even rule. But let's see how we actually how this conversation will develop. So, what made you start developing your new swing model?
So there were two main catalysts. The primary one was I started teaching more, and I found that when it came to actually communicating my thought process behind my trading, so much of it was just derived from my experience. It wasn't as mechanical, let's say. It wasn't like I was doing the same thing day in, day out. And it meant that although my results were good, I was withdrawing money every month. It was very hard to communicate to somebody what I was seeing. So much
Mm,
nuance, so much subjectivity. And with that, it also made my trading more stressful for me, anyways, because it was different all the time. It was like I was going to battle trying to find something using basically taking different setups because initially it was just higher time frame, then I incorporated lower time frame, and then I was trading them both together. But it,
mm,
it was like sometimes it was a higher time frame bias with a lower time frame entry, and it was just a little bit too subjective. So then when it came to trying to explain that to somebody, there was no way that I could.
mm,
And it was just, yeah, just complete overwhelm for them. So I said, you know what? My trading has become more stressful now. I'm not enjoying it as much now because you don't want to do something that's stressful every day. I was thinking a few months ago, 6, 8 months ago, my trading was just super, super peaceful, relaxing. I was loving it. So I said, you know what? What made me not like it anymore? It was dropping down to the lower time frames, that high intensity, the adrenaline and everything. Initially, I liked it, getting back into it, but every day, no, it's not for me. And then that coupled with I started seeing the data from prop firms. Something like over 70% of the people who are withdrawing on a consistent basis, let's say longer than 1 year, over 70% of them are more higher time frame traders.
interesting.
So I said, you know what? It's a triple win. It's more relaxing, the data backs it up, and it's easier to teach. It's more simple. It's more so like right
Mm.
now, my trading it's super mechanical again.
The next question. So a few weeks ago, you mentioned that your frequency of trades was 5 to 10 trades a month. Was there an urge to trade more, and that's why you got into lower time frame, or was it something else?
Yeah. So let's say this time last year, I was taking maybe an average of 3 to 7 trades per month. For months, it would be very rare that I would take 10 trades in a month. And that was when I was super relaxed trading. It was super peaceful.
Mm,
Then I started, I was progressing with that. And then I wanted more, I guess, a bit of greed, let's say. And I don't remember how it happened. I did. I invested in more mentorship from an old mentor that I had for years. And he was back again talking about the lower time frames. And
mm,
then after going through that, I then incorporated it again, had these rocky months or this transition period, and then had some very strong months, like had a 13% month, a couple of months over 10% or in and around that. And I was like, okay, this is amazing. Like I was doing about 3 to 5% per month on the higher time frames. And then I saw a big spike. So I was like, okay, this is what I should be doing. This is more optimal, let's say. But then I had my first losing month. So in the last year, I've had one losing month in the last 12 months, and it was when I was just doing lower time frame. So it's much more volatile, more room for win, but also more room for loss. And the whole time, I was just more stressed, like genuinely just super stressed. I was like, this isn't enjoyable, man. Like, I'm not vibing with this. So yeah, I think it was more of a greed thing. And now that my trade frequency has reduced again, my confidence has increased again, and I'm just more relaxed. It's just a more enjoyable thing to do every day.
yeah. So
How many
would you
trades are
like?
you?
Actually, sometimes, like on Friday, I had the 7 setups coming up because I had trade actually multiple currencies, and I trade the best setup I would see that is coming up. So we have 7 setups. It's not like I'm going to trade 7 trades at the same time because then your floating risk might be a lot. So I would take one trade, wait for break even rule, and then I will look for another one. Or
Okay.
if there is not conflicting currency that I'm trading in initially, I would look for additional trade. And so, based on the strength of the setup, I would reduce my risk or keep it, regular like I usually do. So I could have sometimes like last week. So because I had my big losing week around 6% down in drawdown. I lost one funded account on that in that week. That was 2 weeks ago, around 7 to 10 days ago, because I felt overconfident. I felt like, oh my god, this system is so good. It reduced my screen time, I would say, for about 70%. My stress level was so low because I'm using Aura Ring. I could see what was my stress. So my stress was so low. I was like, this is something that I'm going to keep going on because I have an intraday model as well. And the intraday model is not lower time frame like 1 minute, 5 minutes. It's more like high time frame, but then I will look for entries on 50 minutes. So not lower than that. And in order to keep myself focused on the time frames, I won't have them bookmarked in my trading, which I'm going to show you. So I will have only the time frames that I'm looking for. And but yeah, my screen time got reduced for 70%. We just before our call we spoke about going to Vietnam, and I want to start the business there. So I don't want to be at the screens the whole day like I used to be, because when you live in Asia, your London starts at 1 or 2 p.m. Depending on the time of the year, and your New York starts at 7 or 8, also depending on the time of the year. And so sometimes I would spend my afternoon on the charts. I should go, do something, but I will have to be at my charts almost going to sleep. So I would close my charts and then I would go to sleep because it's that difficult. But now, actually, I've been thinking about this model and I've been developing it because it will help me live easier life in Asia. Because my main focus is placing my roots in Asia, and so I want to adopt trading model that fits my lifestyle, not something, you know, not some magic trading model or system that I think is best for me, but what fits my lifestyle. What do you think about how does your new model fit your lifestyle?
So much better, man. So much better. And it's again, it's not going for the system that's going to make me the most profit possible. And I think that's what I ended up optimizing for. Is like, how do I make the most possible profit? The most possible profit means that we're pushing. We're pushing the limit, and everything that goes up must come down. We will rebound from that. I think it's more like if we have a swing up like this, we'll have a swing down like that. What I want to do is optimize for longevity and just keeping the fluctuations less extreme, let's say. I think, yeah, optimizing for longevity means stuff like that, like having been able to trade lifestyle wise. Uh, Scalping and lower time from trading, it means you're pretty much there for, or at least for me, I was there for 2, 3 hours every day. Now I'm again potentially there for an hour and a half, maybe 2 hours, but maybe then I'll be just monitoring for maybe 2 days after that. So yeah, it's reduced it massively.
So you mentioned that that scalping is something that people shouldn't do. You know, there are scalping models that are really good. People having really good months with them, really good returns. And also, I heard a few months ago, I think there was some trading competition. I think maybe or by TradingView or by maybe some other company. I'm not 100% sure. And there were some traders that were using order flow, scalping models. One of them was trading Nasdaq. And so one of them won. I think he was either second or third place, and he had really good return. But what people don't see when it comes to those returns, okay, you have a really good return, but people don't see that he was 60% in drawdown. I'm going to repeat it again, 60%. Imagine having 100K account and getting to 40K, which is a lot. Imagine the amount of stress and amount of. I want to live more than 100 years. But with that amount of trading model, like people don't realize, like, okay, order flow works. I don't know, there are scalping model that works, but I see myself living more than 100 years. I don't want to, get my grace in my sooner than I think I should get them. So I think people should always think should they optimize for their identity and their lifestyle, not for returns, but for their lifestyle. Because that's what we drawn to, social media stars, big returns, big profits. We want to be on some leaderboards, you know, but that sucks. I don't think it's something because you're chasing outcome. Okay, trading is a game, but then at the end of the day, you're chasing outcome rather than process oriented system that will keep you going for a long time.
Yeah, completely. And again, also then seconding that with the data is like the data for traders being profitable is already so low. And now we know that the institutional and the prop data is saying that only 30% of the consistently profitable traders are actually short-term traders. That means you're only 30% of 5%. The odds are just completely stacked against us. But I love that point about, yeah, dude, it fully ages you completely, man. You feel it after a week.
Yeah. So would you like to share your chart and show us what you've been developing, working on?
Let's do it. Cool. Share entire screen. Um, so just while it's loading, one of the things that I love, and also why I think even if someone thinks that they do want to scalp, that they definitely do want to do that, that it can be something that you can switch to eventually. One of the reasons being that the whole thing of the decision making time. For my strategy now, I'll only enter on a 30-minute candle closure. So I have 30 minutes to decide whether or not I want to enter this trade or not. It means that I can check, double check, get all my confluences, prepare, have a written note why I'm
Mm.
entering it, taking my screenshots, risk is sorted, everything is fixed, and I'm not entering in enough of a 1 to 2 minute decision and then trying to then record all that data.
Okay, Luke is having some technical difficulties setting up his trading view screen, so I'm going to do it first. Um, I'm going to share aspects of the trading strategy I'm going to keep developing and what I've been working on in recent months. So So the thing that I'm working on is really straightforward. What I'm looking for is a trending order block. Supply and demand. People call it multiple waves. Point of interest, POI, order block, bid array. So there are so many names, but this is the thing that people don't understand. This has been on the markets for decades, and it's not something invented concept that has been for a few years, like ICT or some other concept. This has been on the market for years, for decades, actually, maybe even more. And it's the concept that the it's in DNA of the market. Supply and demand concept exists since, I think, technical charts. So it's not something that was developed recently. It's not something that people think that doesn't work. It's price action throughout the decades has been the most profitable strategy ever. Indicators came along because people wanted to increase their frequency of trading and like different aspects to tweak it to find their edge. But price action world and supply and demand concept has been working for decades. So having that in mind, so this is what I'm looking for. So I have 4 setups, actually 5, but fifth is actually something that is also in the A plus stage, A plus setup. So what I'm looking for is a break of structure, and I'm going to write the rules here. So what I'm looking for is 4-hour time frame. So I'm looking for a 4-hour time frame that broke the structure. So high or low, depending on the range I'm looking for. It's either it's 4 hour. So I'm looking for what I'm looking for is in this range. So in this demand, and I'm going to write how it looks like in a I would say modern economics. Imagine this is the time, and also this is the price. So we have time and we have price, and the price. So in I forgot what year, but in Chicago, modern economists wanted to have a thought that markets are efficient, that markets will always be efficient no matter what uh, what is going on the market. But markets are by rule inefficient because of greediness, emotions, and so forth. And there's so much participants of the markets. Markets are by law inefficient. We wanted to keep them efficient, but in a that can work in theory, but in a real life situation it doesn't work. And so I'm just going to delete this really quickly and then I will put it back. So we have time. So we have time and we have price. Certain economists said that market is always efficient. So we have price, we have time, and we have equilibrium. So the price will always try to balance itself out, trying to be efficient. And on the charts we can see that. So that is called consolidation, efficient price action, and so forth. And the price will keep moving higher over time. So the price will keep increasing. And so imagine we live in London, you and me. Imagine that. And so and both of us are selling umbrellas. We're selling umbrellas. You have your stand, I have my stand. During sunny periods, the price is balancing itself out. It's usually in equilibrium because there is nothing that puts it out of equilibrium. So the price is balancing itself out. And so what happens when the rain starts falling? So by you can see so many examples. When the rain starts falling, when there are sunny periods, you have uh, you have as I said, periods of, I would say, prices rising slowly over time. Maybe I should take another asset class, but umbrellas are pretty simple to explain. So the price is, let's say, rising slowly over the weeks, over time. Imagine we are living in the part of England when there are longer sunny periods. Let's put it that way. But then suddenly we have certain demand on the market, and you and me have a certain supply of umbrellas that we are putting on the market. What happens when the rain falls? The demand rises really quickly. So everybody needs umbrella at that time. And so you and me have a certain amount of umbrellas. So we have a certain supply that we can offer to the market. But then there is so many people asking us for umbrellas. And so we were like, okay, we can use this situation. There's so many people asking us for umbrellas. Why we don't put our price higher? And so that's when the that's when the price rises, right? And so at the end of the market, there are going to be levels where the price went higher from. So from this level, price risen higher, and so that is becoming level of interest. So let's say let's say now we have sunny periods again. The price is trying to balance itself out. It's trying to get back into equilibrium. But then there are other players in the market that have seen that situation. They're saying, okay, so we want to keep this level because a few weeks ago, this level, so the price of umbrellas at this level was okay for us to keep our margins and profit margins fine. So let's keep this level. And so let's, from this level, let's keep rising the prices higher, but slowly, let's, so then we have another equilibrium. So then we have another equilibrium that is coming up. And so what is happening now, we are again in equilibrium. And so again, we have rain, and then suddenly you and me that were first players on the market produced so many umbrellas now that we were like, okay, so we have really large supply on the, because we've seen what happened before. We've seen that we made so much money, we invested in production, we created more umbrellas. So now let's just keep selling them to other people. And so let's just put our supply on the market. And so what happens, the price will drop sharply now because we drop higher supply because we have so much umbrellas, but then there is not enough demand for such amount of umbrellas, and then the price will drop. And so that's what we see, that price is reaching certain levels, coming to demand and rising again. And so that's the law of supply and demand, economics 101. And so when we think about the situation that I mentioned before, I'm using 4-hour time frame to find order blocks, aka levels of interest that price has risen or fallen before from those levels, and those are becoming my order blocks, points of interest. Call them, people can call them the way they want it. So for me, it's just interest level, key level, whatever the name should be. And so what I'm looking for, so I have a few setups. So the first setup is A plus setup. So what I'm looking for in 4-hour time frame, I want to see certain type of reaction. Opa, this is too big. So I want to see certain type of reaction close to that, to my level, and I want the price to react. But here's the thing. I'm going to show a real life situation. Even now, I think I entered the trade. I'm not yet, but I'm going to show you a real life situation. So I want to see certain reaction from this level. So what this reaction is going to help me, there are going to be players that are going to look for this demand to long for from, because most of the players are looking for lower time frames. 30 minutes, this can look really well. So what I'm looking for is actually using those players. It's going to give them reaction, but what I'm looking for is using this reaction as a liquidity pool or rocket fuel to propel my move higher. So this is my A plus setup, and that's the whole thing about this setup. So the next setup is, okay, give me just a second.
So the A setup is you have the area confirmed, and then you have a second reaction from
It doesn't have
the
to be a second.
initial.
The minimum is one. I mean, I like if I could have multiple reactions, but what I want to see, at least one reaction. So then I have another setup. This one doesn't have a reaction, but has a certain level of liquidity lying higher. And so what I'm looking for, I would enter straightforward from this order block, target these highs. This is also A plus setup. I have another A plus setup. So imagine So let's just imagine the price is moving higher, enters some consolidation, makes liquidity grab, makes a break structure. Also, this is A plus setup. And so I would enter straightforward from this order block because this level took this liquidity, made a break structure, and went higher. And so I have 4-hour time frame. So what I need to see is either, so I need to see break of structure or boss. I need to see reaction. Reaction play a huge role in my model. I need to see either liquidity, and also I need to see liquidity grab. So it doesn't. So all of these things, not. So I need to. So for example, for this level, so always I need to have break of structure. So let me put that as a main rule. So that's a foundation. But these are just the setups. I have either reaction, liquidity, or liquidity grab, as I pointed out here. But then I will have another type of setups. So it's still 4-hour time frame. So I would have break of structure and just order block. So I would set my risk. I would set my risk 50% lower than A plus setup, but I would still want to trade from this level without reaction.
So on that one, you'll enter as you approach the order block.
So I set my limit order. So if I see a reaction, I would change my risk level. So if I see a reaction,
Okay.
I would change my risk level.
Okay. So you reduce your risk then.
So this is B setup. And also I have another setup. So this is B setup. And this one has break structure, as you can see. This one has break structure, but this one, let me put it this way. Let's say I have trending market. Maybe this is not right. So this type of setup, I'm just trying to, it's not right. I have a picture. I don't know why I'm struggling to draw this thing down. Let's say I'm in the trending market. So what I would want to see, I have my demand level. So what I would want to see is reaction. So keep in mind that this is still 4-hour level, but it doesn't have break structure. So what I would need to see is reaction close to that level. And then I would trade that. And so I have fixed protocol 3.2. So for each of the setups, I have 3.2. And also I have break-even protocol. That's something I would like to discuss with you. So it's either 1-to-1. It's either bullish engulfing 3-hour, 3-hour or 4-hour. Okay, we can put it here. Or the price is close to the news. I will just write news. So that's break-even protocol. And so this is everything I do it on 4 hours. And so this is actually my trading model. It's super simple, and it works. It's giving me good results. And it, as I mentioned before, decreased my screen time, I would say by at least 40%. What do you
Huge,
think?
huge. Yeah, it's super simple, man. I love it. I got some questions. So, are you using just 4 hour structure, or are you using higher time frames as well, or lower as
Just
well, or
4 hours.
literally just 4 hours?
Just four
Okay,
hours.
cool. Super simple.
So
I like
so
that.
so I was thinking about using multiple time frames like daily or weekly, and I would use them in certain occasions if I see some certain liquidity levels, or let's say I don't like supply or demand level. I would use also 3 hours. I would actually play with 4 hours and 3 hours. I like those time frames. 3 hours is really good time frame. It sometimes can give me 20-30% better risk reward than I would usually look for. And also, like let's say 3 hours, let's say on 4 hour I have level, but then 3 hour would confirm it, and let's say 2 hour would confirm it. So as you can see, my time frames are, I'm always 80% of the time I'm at 4 hours, but then I would play between 1, 2, 3, 4, just to see how those levels. But I would enter from 4 hour time frame. And so what I wanted to ask you, for example, I'm going to show you certain setups right now. Okay, so I was trading for our, I was trading. So this is my setup for tomorrow. So last week I was trading this level. Actually, it opened my trade yesterday. It opened my trade yesterday, and so as I mentioned before, my if I see bullish engulfing like on 3 hours or so, I would move it or 1 to 1. So the price went to 1 to 1. I move to break even, but then price came back. So it came back here, stopped me on break even, and went higher. And so now it's close to my, almost close to my take profit. And so the same thing happened on Monday too. I was holding my trade overnight. So this was GBP CHF. I was looking for to trade from this level. So the price came back, stopped me out, and then now is going higher again. So the same thing, Euro GBP a few days ago. So this was for our entry. Just find it. So this is for so here, all the price came to 1 to 5, came back, and then went straight to TP. And so those are the things that I'm struggling with right now, and I'm trying to find a workout. Should I? Because I like break-even rule, because there are certain occasions like that if I think of the CHFJPY, or was it? Give me just a second. Was it? I think it was AUDJPY. It was AUDJPY. So we have this level. I think this is 3 hour time frame. Yeah, this is 3 hour time frame. So the price entered here, came, so I moved to break even, then went straight to break even. So
I
this
was
will
long
be,
there as well.
so, and I'm trying to find the rule that would, because I would rather focus on opportunity wise, because those break evens would be winners, and then they would deduct losses. But then still, I'm trying to find my. Let me just see where were my. What was the chart I was using when I was showing you? Was it
Euro GBP?
no, where I was drawing the pictures?
Oh, I don't know.
I'll have to go, but no worries. But I just wanted to hear your opinion. So, for example, I'm looking for to short from this level arrow NZD. So as you can see, we have liquidity level that I'm targeting. And so this level broke the structure. I'm looking for to short from that level. But I'm
So yeah,
struggling
I've
with
got,
break even. I want to hear your opinion.
yeah, dude, I'm in the exact same position now with the break even side of things. And my only answer is, again, what it always is like, if there's a question that can be answered with maths, we must answer it with maths. And then it comes, okay, how do we actually quantify this? Because we want it to be a number. We don't want it to be based off of feeling, anything. We want to know, is going to break even hurting me, or is it actually benefiting me? And then there's the element of the qualitative as well. It's like how much psychological relief are we getting from going to break even? So then for me, it's like, okay, first of all, I want to quantify it and then see, is it hurting me or benefiting me? And then by how much? Because if it's only a small amount that it's actually benefiting, then it can be worth still incorporating it just for the whole psychological relief of less losses, let's say. But then, first of all, we have to answer whether it's beneficial or not. The way that I'm currently testing it and the way that I'm gathering my data for this is, the only way that I've found is, it's pretty simple, but it means we have to have a fixed risk to reward, or in and around at least somewhat fixed. So you're in the perfect situation because you have 3.2, it's fixed. And then what I would do is I would just track, okay, on one of your columns on your data, just have TP, stop loss, invalid stop loss, invalid break even. So basically, so valid break even, invalid break even, valid stop loss, invalid stop loss, take profit. And then
Mm.
we can see over 50 trades how many of those break evens were invalid break evens. And by invalid, I mean it took us out and then continued to take profit. We can then see, okay, out of the last 50 trades, 20 of them were invalid break evens. So that means 20 of the last 50 trades took us out at break even and then went to take profit. That means then we can then do the multiplier and say, okay, 20 times our average trade or, so yours is 3.2, 20 times 3.2, and then just compare that to the number of valid break evens. And that would then show us two figures. How much did break even save us, which is our valid break evens, and then how much did it screw us over? So that's literally it, the numbers will tell you whether it's beneficial or not. For me, they have proved to be beneficial, but I'm still depending on now what's my mechanical rule for going to break even.
How would you
So
phrase
I've
those
got two
questions?
things.
Sorry for interrupting. Let me just go back. How would you phrase those questions? Uh, for so I could so in my trading model I could just add so that this would be post evaluation thing of the trade. I would say did so let's say I'm trying to find a way because I'm trying to find a way how could I ask this question. Well, let's say I could say did break even save me? Yes or no? So I would say yes, no.
Uh, yes. So you'd need to go a step deeper. So you'd say like break even saved, break even wrecked, stop loss saved, stop loss wrecked. So you want to know whether it was a useful break even or a non-useful one, but then also whilst tracking it with the stop losses I found. So it's all just it's basically the way that I would call it is trade result. So you're just calling it result, and it's either TP, invalid break even, valid break even, invalid stop loss, valid stop loss. And that way you're tracking, you're getting two core pieces of data. You're getting whether your break even helps you or not, and whether your stop loss needs to be increased or decreased.
Do you mean this way? So I would say
Result, trade result. And then I just include one more, which would be invalid stop loss. And that would be the same principle where it hit your stop loss, it didn't continue in that direction. It was just we got wicked out, let's say, and then it went to TP.
But
And
but you
that
know
combination,
but you know those combination, I don't think that combination, so that fifth combination is right, because you're going to have certain times when price hits your stop loss, it will keep going higher, but then still I protected myself based on what I'm looking for. So let's say my in this case my supply level is, it consists of, so I'm looking for last buy before sell. And so I would circle the whole candle. So this would be my zone. This would be my interest level. And so I would target my, so I would widen my zone all the way to the first imbalance. So that would be my zone. Let's say I'm looking for this level here. So I would include this. So I would include first imbalance and the wick all the way down, and that would be my zone. And so as you can see here, here we have little imbalance, which makes it valid. So this is this reaction. So this is liquidity. I'm looking for to take out that level and the trade from that.
yeah. So it's definitely not perfect, but it's more so, let's say, like, was that zone correct? Like, what was your thesis correct? And then it was just a matter of stop loss placement that you got taken out of it, or did price actually continue and close through that zone?
Okay, where were my? I already forgot where I. No worries. For example, I'm still looking for this trade. I have still small imbalance, still valid zone. Okay, the price came here, went down, but still, this can be a reaction that I'm looking for to be taken out. But thank you. I actually, I'm just going to write again down. So I have valid TP, valid. Did you say valid break even?
Yeah,
Yeah,
yeah. So,
invalid
so it was just,
break even.
yeah. TP was just flat, so just take profit, valid break even, invalid break even, valid stop loss, invalid stop loss.
Okay, I will
And
actually
yeah,
take a look
I
at
did have
this.
it a little bit more complex than that, but again, always optimizing for simplicity. This is what is easy to record, it's sustainable, and actually gives us two really core pieces of information. But again, nothing is ever 100% perfect with data, but this is yeah, this is the what I found to be the easiest way of getting those numbers. Dude, what I love about this strategy is that it's just a 4 hour. I really like
Yeah,
that. Like, it's super, super simple. Like, it removes so much
guessing.
reason that you could beat yourself up. Like, it's like you can't be angry at yourself because you're trading what you see. You know what I mean? It's super mechanical. I really like that. And you can see the charts now.
Oh, you're longing GC like I did.
Just with yeah, I laughed when you pulled it up. Um,
Actually, almost
so
the same TP like I had. Is it 3.2?
true.
Ah,
So I'm going for a fixed three now. Just a standard three each time. Let's pull up ETH, and I can just give you a breakdown because I had some analysis on ETH. So, dude, my strategy is very, 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 very similar. Again, all strategies are pretty much the same thing. Like, we're in an uptrend, we want to be buying somewhere near to the swing low. Let's say, like, we always want to be buying in a discount, um, or at least in the lower half of the range. So, what I do, super simple. I have two core setups. One is higher time frame structure based, and the other one is a monthly extreme based. And let's talk through the market structure one first. So I'm basically looking at the monthly, the weekly, the daily, and the 4 hour, and then wanting to get as many of those in alignment as possible. So it is primarily a trend following strategy. And I'm just looking at, okay, monthly is long. Let's drop down to the weekly. So I'm looking for the most recent breaks of structure. So again, here we can see the most recent break of structure was to the downside. But if we're looking at the overall big push up, this is just a natural, because the monthly
Retracement.
had such a large push up, weeklies, yeah, exactly, just going to have a natural retracement down. So on ETH then, I'd mark out this most recent swing up. And the way that I simplified it is just using the interest. So I'm not actually paying any attention to order supply and demand zones. Look to just come into this area and have the action. The way that you have just utilized 4 hour simplifies it massively. Me then using just utilize it's less data to process, let's say. And then I'm just waiting for price to pull back into that area and then have the reaction from. So up what trades in load. So just this morning to load, and
Are you
we
trading
can
crypto?
see all higher time frames are in alignment. I'm I haven't entered the position in a while, but it's list. So I'll monitor multiple markets, but on the weekend I do my analysis, and if I don't add it to my watch list on the weekend, I have a rule that I'm not allowed to trade it. So this is my only pairs that I'm trading this week. These are my long pairs and these are my short pairs. But yeah, super, super, super simple. All time frames are long. The monthly, the weekly, the daily were all long. So then I marked out my area of interest. And I
So can I
literally,
ask a
so I'll,
question?
once
Can
the
I
time
ask a,
frames are in alignment, I'll
I have
have my,
I have a question.
of
So
course, dude.
what is the frequency of all time frames being aligned?
So I have a rule where I have to alignment. So it can be the monthly, it can be any of those combinations. And they have different win rates, but I'm still gathering data on what is the highest. The current thing that I'm testing now is under what conditions will I allow me to trade against weekly structure? Because from the small data set that I have so far, the highest number of losses have come from trading against the weekly structure. So that's the one thing that I may change. I need the weekly structure, let's say. But in terms of all of them being in alignment, I don't have a number for you now. But my trade frequency has increased. And again, if I want to reduce it, I'm now just testing to see, okay, which combination of these do I not want to be taking? So this setup, we can look at it on the daily. The daily, the last move up, I'm just measuring that, the most recent range, and then waiting for price to pull back into either, let's say the 618 or 786 of that. So if we look at it on the daily, we can see that we measured this last move up. Price on the daily then has a natural pullback to that area. And then ideally, I'm waiting for the 4 hour to shift from that area. So we're in our golden zone, let's say, or our considerable pullback area. And then I'll drop down to the 4 hour. I'll only drop to the lower time frames once we've entered the higher time frame area of interest. Then the 4 hour shifted here. So then I measured this 4 hour move up and waited to pull back here. So this was actually a 30-minute break structure. And So daily zone, we had the reaction or shifted. We had our 4-hour area, bullish, super straightforward. And then we hit structure here where I entered. So break a structure. And then GDH is the GBPC is my dream. So it's just simple bias is possible. I'm having two setups. One of them is just having the higher time frames in alignment. So looking at the monthly, the weekly, the daily, and the 4-hour. We want 3 of those at least to be in alignment. If we have 3 in alignment, then and only then do we drop down to the lower time frames, and I will look for either an hourly or a 30-minute shift or a reaction / confirmation, let's say. But I'll only do that if we're in the higher time frame area of interest. And the area of interest is literally just measuring the last move up, either on the daily, on the 4-hour, that's caused the break of structure, and then just entering in on the Fibonacci areas between the 618 and the 786. So when it comes to actually entering, we want, the first thing is we want price to actually be in that area. And then it's, once we reach that area, what I want to see is price to ideally dump into that area. So dump against the trend, so volume into the low. I would love to see then sideways behavior, so maybe relative equal highs or lows being put in place. Love to see those being liquidated and then having a shift. So the entry side, it's slightly less mechanical, but it's mechanical behavior. We want to see certain price behaviors happening. Or if everything is super, super, super picture perfect, then we can just enter on all time frames being in alignment, like GBP, NZD was there. All 4 are in alignment. So once we enter that area and then have a 30-minute shift in structure, boom, I'm in. Any questions on that before I talk through the monthly extreme?
I wanted to add something. So it's really hard to make everything mechanic. What's that word?
Mechanical.
Mechanicized. Yeah, mechanical. It can be really hard.
Yeah.
I know you're data driven. You're extremely data driven, and that's something that I like the most about your style and about you. You know, your mind is data driven. I'm trying to actually adapt that thinking part, but what I wanted to say, it's really hard to make everything mechanical and to quantify everything. I know you're trying to do that, you know, but there are certain parts in the price section. It's so hard to say something. This why enter. This why love this level. There are going to be occasions when somebody asks me, "Okay, why did you choose this level?" I don't know. It just looks great, and it's so hard to transfer it into, to put it on the paper. That's why
Yeah,
actually
and
I
it's
have 5 setups. It's kind of quantified mechanical, but it's not like perfectly. And I like the way, you have, okay, out of 4 time frames, I have 3 time frames that needs to be aligned, which I like. It might be some noise, along the way, because one time frame can say this, 1 second, and just having all 3 time frames in alignment is something, worth patience a lot.
and yeah, even going off what you say there, that's it. If I explain it completely black and white, there is some caveats, there is some nuances. For instance, I didn't mention liquidity at all, like hard time frame liquidity. If we have a false break of a weekly high, let's say, and then a large engulfing candle on the weekly, even if it's not structure, I will look at that as a weekly signal, let's say. So then I could take a trade if only 2 of them are in alignment. If that makes sense. Like there's
Yeah.
certain caveats, certain nuances that will make certain trades slightly different. And that's the whole line. It's like the dance between super mechanical and trading what you see, like optimizing for, okay, how much complexity do we want to add to improve win rate versus how simple do we want to keep it that it's super repeatable and scalable. Um,
I believe you
and
have
yeah,
data
you
for
definitely.
Fibonacci. So what is the percentage of price hitting 61 or 61 or 70% something? So what the price is hitting the most often? Which level?
So yeah, so it's hitting the 50% pretty much every time. But it is pulling back to, so basically I will only utilize the 50% if the move that we've had is extremely violent, one directional, and we leave a large imbalance on, let's say that on the daily. If that happens, then I'll be more than happy to take a trade from the 50%. Unless we have that behavior, like a large range, like let's say the average weekly range, then I will always wait for the 618 and 786. But yeah, the 50% gets hit pretty much most of the time.
Yeah,
But but it's, yeah, it's definitely the more risky zone. And then when it comes to stop loss placement, if I enter on the 50%, I have to cover the 618 and ideally as much of the most recent body candles on a recent swing high, let's say. If I enter on the 618, I have to cover the 786. If I enter on the 786, I have to cover the low of the range.
yeah.
So it keeps it super mechanical. And then take profits are just 0.27 and 0.618 extensions.
Yeah, I have more questions about Fibonacci. So the price, let's say, will reach 80 to 90%, 50%. So I mean, just by looking at the charts, we can say that, price will drop to at least 50%. And so there's some data, and I found that I'm trying to find that correlation between your style and what I heard. So I don't know if you heard about the trader called, I think his name is Burned or something. On Twitter, he shared a few weeks ago or months ago, people who using Fibonacci, that the price will hit almost the same time each level, and some traders will think that the price will hit certain levels more than other levels. Okay, I would say 50% is at least 80%, but I'm trying to find the correlation between other other levels, because I heard it's so random that it's so hard to find correlation between those. What are your thoughts on that?
Yeah. So when it comes to this area, the whole reason for me using Fibonacci is to simplify things. It's to actually
Mm,
remove the complexity. And again, I do have a small data set right now, currently utilizing it, but I'm also not currently, at least. So again, I'm tracking every time which zone do we pull back to, whether the 618, 50, 786, was that on the 4 hour or the daily fib, um, and then which one did we extend to? Right now, I don't have enough data to analyze it, but I'm also not super inclined to keep double, triple clicking on that to overcomplicate it, let's say, because the whole reason for incorporating it is to simplify things. It's to basically remove looking for liquidity and order blocks on the left. Your one is fine because you're just utilizing one time frame. That removes the subjectivity. Because I'm using multiple time frames, like, do I use the daily order block? Do I use the 4 hour? Maybe I'll drop down to the 1 hour, etc. It's too much things to think about, too much data to process. So I said, you know what? We know that these levels are hit repeatedly. Again, Fibonacci, we can look at it, it's everywhere in the universe. So we know that this algorithms, again, I don't think it's just one algorithm, but we know that something goes up, it must come down. It's just a way of standardizing and ensuring that I'm buying low and selling high. But yeah, in terms of actually going and super into the data and figuring out, okay, what percentage of time I don't have the data yet in time, maybe a data set, then I can start to unpack it more and maybe add more complexity. But yeah, for now, more for the simplicity. So yeah, we'll see. But I do think if I have the data, I will want to figure out everything about it because I think it's so cool.
I have something cool to share with you. It's a propria. What's that word? It's a custom-made indicator that
Battery.
yeah, that's the right word. So I have a certain indicator that I'm trying to incorporate, and it's called, so it's a VWAP. So this is custom-made indicator. So what it does, it's measuring the average volume on three biggest exchanges, and so it's giving me certain level. So I'm going to describe you this way. So imagine we have a population in some village. Let's say we have 1,000 people here, and imagine we have a curve, and so we try to measure IQ in this population. So this is one extreme. This is this is second extreme, and so this is the middle. This is where the majority is. So in this range, so let's say, so in this range, let's say 5% of people will have 70. I don't know what's the smallest EQ, but let's say it will have 70 EQ baseline. Average is going to, I think average is 90% will have 120 EQ. And also 5% will have 180 EQ. And so when it comes to using that indicator, so what it does, it measures institutional volume. So we're not interested in where the majority is, because this is I don't know what's the word on English, but let's say this is a butchery. Everybody's, killing each other at this level. So let's say we're not interested in where the majority is. We are interested in extremes. So extremes are giving you higher risk reward, I would say. But when we're looking at population as a whole in these 1,000 strong village, so we want to look at extremes. So when it comes to using this indicator, so what this indicator tells me, so as you can see, this is one extreme, this is second extreme, and this is middle. So I want to see extremes. So if I actually pull out any chart, so what it's going to do, it's going to automatically show me where those ranges. So as you can see, the price will play out from those levels. Sometimes to the point. Sometimes will come close to those levels, but I want to find some strong example. So for
And tell
example,
me, is that volume traded at those levels?
yeah, so it's showing me, but here's the thing, it's not about using one level. It's going to give, I can use different time frames. So let's say I use month. So now if I go to monthly level, I can see that these are extremes at monthly. And so let's say I'm trading this way. So what I want to see, price liquidating this level, coming back at about that level and then looking for entry. And this simplifies a lot of things. I think GA came exactly to the weekly level. Let me just check. So as you can see, the price will keep testing. So sometimes we'll reject exactly at those levels, literally to the pip. And so it measures institutional volume. So VWAP is one of the, I'm not going to say best indicators, but the most used by institutions. And so if you see where there's most volume, so using those extremes, those are areas of interest. So if I would looking at your strategy, I would more incorporate VWAP than Fibonacci, because Fibonacci is overused. Everybody's using them, while VWAP is something that is used by big players, and it can give you certain edge. But you can use multiple times. Let's say if I would use it this way, I would just draw. I would say this is weekly high, this is weekly low, and then I would change the time frame. I'll go to a month, and then I would use similar things. So as you can see, this is my monthly low, and then this is my monthly high. And so I want to see what the price is doing around those levels. And this tool is amazing. It can be, there are people using it in my community, and some people are swear by it. So it wouldn't something, yeah, it's something that I'm willing to share.
Yeah, volume for sure. It's one of the biggest tools that we have. Again, volume, it's a little bit more difficult in forex as it is in indexes. Like we can much easier see the volume profile on, let's say, like the Nasdaq or US 30. But incorporating volume in some shape or form, it's one of the biggest tools that we have. I'll check that out, man.
Yeah.
Because yeah, as long as I can mechanicalize it, like as long as I can make it repeatable, this is how I approach it every single time. I'm measuring the volume on, let's say, the most recent week, most recent trading month, let's say. As long as I,
Yeah, so I think even with Fibonacci that you're using, rather than second guessing, okay, what would be my interest levels? So it's like giving the power to the universe, to something, to the, I'm not going to say universe, but let's say you're giving power to the Mr. Market. And then Mr. Market is deciding what are key interest levels for you, rather than you second guessing.
Yep. Interesting, man. Yeah, I'll have to find out more about it to learn how I can use it like systematically, let's say. But definitely, you know me, I'm always open to testing. So for sure.
Yeah, yeah. Is there anything else that you would like to cover?
Yeah, well, I'd love to share the monthly extreme, but I don't think it's possible now with this internet. But I guess the main thing for me is both of those setups are very different, but they both have it simplified to a basically the thing that I want to remove is analysis paralysis. I want to be able to objectively say this is my bias. This is the direction that I want to trade in. Once we have the direction, I then want to mechanicalize this is the area that I'm trading from. So then those two things are the main things for me. Mechanicalize the bias, the direction, and then the area of interest. Then it gives some more breathing room for how we're actually getting into the market, because it's very difficult to make something which is not, how can I word this? Like the market is ever fluid, and we cannot take a complete cookie cutter approach and expect it to work every single time. As long as I've nailed the bias and the area of interest mechanically, it then allows for more fluidity, let's say. Sometimes it'll be a break of structure, sometimes it will just be very clearly prices coiling, let's say. And that's where like experience, etc., can play more of a role in. But I think the main part is being aware how much subjectivity do we have versus objectivity, and optimizing for subjective.
Yeah. I think we could wrap up this call. I actually really enjoyed in sharing these things. I think next time we can go more in depth when we get more data and like what people should track in their trading models. I think that's something next that we should cover. But is there anything else that you would like to add as a wrap?
No, dude, just I think it's a great idea about the data thing in the next one, because the data has to get tracked, has to get tracked. Even if we're not, like, it's the whole thing of, if you step on the weighing scales every day, you will just naturally lose weight. If you make sure that you're tracking your data, you will just naturally perform better. So if anyone watching this isn't tracking data, this is your sign to start today.
Yeah. Thank you, Luke, for this call. I look forward to the next one, and I hope if you guys have any questions, please let us know in the comments, and we will share our thoughts.